Investors, how does getting paid dividends every single month sound to you? You see, for me, especially in this economic environment that we are currently living in, whereas inflation has remained stubbornly high for far too long, we all need a strategy to outbeat inflation, and that's exactly where the 4 monthly paying dividend ETFs that I'm about to break down today will come into play. Now, if you're new here, I'm Ari, a go-to dividend investor here on YouTube, looking to keep it Sesame Street simple for all investors while delivering through on economic insights and top-notch discounted dividend stock ideas. But as for today, for the sake of our times, I want to keep it solely focused on shattering new dividend income records with these 4 monthly paying dividend ETFs. So let's dive right in. So just before I go ahead and break down these 4 monthly paying dividend ETFs, I want you to understand why our economic environment is actually making each of them an ideal investment right now, and moreover why ETFs in general will be your best bet for the next 6 months to a year out. And with that said, you need to realize that inflation right now remains sky high at 4%, meaning it's just eating away at the value of your dollar. And therefore, you want to invest into investments that have the ability to pay you more than the rate of inflation, to which you won't need to worry now because all of the funds we're about to mention today are paying well over 4% worth of a dividend yield. Now, here is what you really need to know. Times will get tougher, but do not take it from me. Hear it directly from Federal Reserve Chairman Powell himself.
You know, it's so uncertain right now. In my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though. But it's not.
And with that, Powell giving us everything we need to know and what you should expect. Now, as for how I personally see it, the Federal Reserve will raise rates again, and because inflation will not immediately fall, both consumers and businesses will bear the pressure of inflation while simultaneously being burdened with high interest rates, which will ultimately drive us into at least a mild recession. And that's just a matter of time. Therefore, as investors, let's play it smart and keep it safe by investing only into high quality stocks, but also ensuring profits by doubling down on exchange traded funds, which simply allow all of us to invest into a basket of securities rather than just trying to pick the winners, which is almost impossible to do 100% of the time. Which now all leads me to the very first dividend ETF that I want you to add to your watch list today. It's the Wisdom Tree US High Dividend Fund, ticker symbol DHS, which simply tracks the investment style of high-yielding companies in the U.S. equity market. Now, this fund in particular has placed a heavy emphasis on demand for growth when it comes to the holdings within the actual fund. And speaking of their holdings, the Wisdom Tree US High Dividend Fund currently contains 390 holdings within it, with assets just over $1.14 billion, whereas the top 5 positions come down to ExxonMobil, Chevron, AbbVie, Philip Morris, and Pfizer. So in other words, all companies that I'm sure you've not only heard of, but know to be as industry leaders. And while the Wisdom Tree ETF is currently down from earlier this year from its peak of $87.28, that's almost 7% down year to date, we shouldn't overlook it because a monthly paying dividend powerhouse like this, with a yield coming in over 4% at 4.3%. Now ultimately, if you invested $10,000 roughly 10 years ago, its performance speaks for itself, as you'd now be sitting comfortably on $21,633, which is more than double the principal. But I'll now share that there's one major drawback to this specific Wisdom Tree ETF, and it's that expense ratio coming in at 0.38%, which doesn't seem like a whole lot, but of course over time it all adds up. Yet analysts are still favoring Wisdom Tree here with plenty of optimism, as we see a forecasted share price of $92.84 per share, which works out to roughly 17.3% worth of upside to come. Now, just before I speak to this next monthly paying dividend ETF, I can't share enough how helpful all of you can be in helping me reach more investors like yourselves by tapping on that thumbs up button for the YouTube algorithm. And on top of that, be sure to subscribe to never miss another video, as each will surely help you drive more profits come the year's end. But more on that to come. Let's get back to business here with one of JP Morgan's finest, the JP Morgan Equity Premium Income ETF, ticker symbol JEPI, which may not be all that new to you. though it is in the spectrum of the market with an inception dating back to less than a handful of years ago to 2020 after several JP Morgan portfolio managers worked together to combine experience in equities and derivatives to ultimately get a very defensive equity portfolio that employs a time-tested, bottom-up research and stock selection approach. Now, with this ETF, it has 119 holdings within it, totaling over $27.46 billion in total assets. JEPI has been nothing short of a powerhouse these last few years, with the top holdings being Adobe Systems, Amazon, Microsoft, the Hershey Company, and MasterCard. Now, in terms of an expense ratio, it is a bit better than the Wisdom Tree ETF, but still higher than I'd like it to be, coming in at 0.35%, which is $35 per $10,000 invested, which again may not seem like a whole lot, but over time, just another waste and a shame, as I like to enjoy expense ratios that are really starting with 0.0x%. Yet many investors can often overlook the JEPI expense ratio because the fund has done a great job executing on its goal to generate income while limiting volatility and downside. That's exactly what our current market conditions are calling for. Anyhow, as of right now, JEPI is still trading for only $55.06 per share, which is actually up on the year by almost 5% year to date. But now check this out. Although we cannot go back a full 10 years, if we did go back to its inception date, a $10,000 investment would have yielded us in returns mounting to $14,213 right now. And as dividend investors, what a joy here to have JEPI's dividend yield, as it's coming in at 10.95%, with analysts only foreseeing plenty more upside, over 11% worth of it coming our way. So the forecasted share price is coming up to $61.64 per share. Next up, another JP Morgan dividend investor's favorite, the JP Morgan NASDAQ Equity Premium Income ETF, ticker symbol JEPQ, which was only founded about a year ago in May of 2020, following JEPI's massive success, and therefore its strategy is similar yet with a different approach. With JEPQ, the portfolio managers are solely focused on NASDAQ technology-based stocks, meaning a higher overall beta and less diversification. However, JEPQ is still all about selling options and owning securities, with a total of 81 holdings totaling over $3.73 billion in assets, with the top 5 holdings being Microsoft, followed by Apple, Google, Amazon, and Nvidia. So you can imagine, as tech has been booming rather recently, JEPQ has been soaring to new heights. And here we are now trading for $47.93 per share with this ETF. That's up by almost 25% year to date, and analysts who are still foreseeing more upside, almost 7% worth of it on the way, with the price rising to $50.95 per share. Now, JEPQ's biggest downside, aside from having the highest beta on the list today at 0.89, is their expense ratio, which is also coming in at 0.35%, meaning you're shelling out another $35 per $10,000 invested. But you may feel it's worth it with all the profits being made from this fund. Heck, going back to its inception date to just a year ago, you'd now be sitting on an additional $723. And if the tech sector continues to run up, which it probably will, we can expect plenty more profits. And just sit back comfortably on that dividend yield coming in at 11.78%. Last but not least, if you're anything like me and you're more about playing it safe to ensure better profits over the long period of time, you'll want a lower beta of a fund that still ensures long-term growth, and that ultimately can be found in the Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD, which invests at least 90% of its total assets in common stocks that comprise the S&P, with a focus on securities that have historically provided high dividend yields and low volatility. And ultimately, to ensure just that, the fund is rebalanced semi-annually. Now, as of this video, it has 51 total holdings within it, totaling over $3.23 billion in assets, with its top 5 holdings being Altria and Verizon, followed by Kinder Morgan, AT&T, and Williams Companies, which brings its beta down to 0.66. And it also keeps its share price hovering around $41.10 per share, which is only down nominally on the year, about 5.3%, which is nothing compared to most stocks that have just been experiencing a ton of volatility and sharp declines throughout 2023. But let's talk about SPHD's performance, because here's where it gets green, like really green for all of us dividend investors. So if you invested $10,000 10 years ago, today you'd be sitting on over $22,890, and throughout that time, never really experiencing that much volatility like the rest of the market. And looking ahead, analysts only foresee more upside. If you were to get invested right now, that's about 14.17% worth of it coming your way, with SPHD's share price appreciating to $46.92 per share. And until then, you'd only be hit with a 0.3% expense ratio, meaning $30 per $10,000 invested. Yet you'd secure that dividend yield of theirs that's coming in at 4.22%, which again, if you're looking for a more balance here, it's all with SPHD. But now let me know what you think. Comment down below with all your thoughts on these ETFs, especially if you own any of them. Now you don't have to go too far for my next video, just be sure to click right here, but also don't forget to tap on that thumbs up button and of course subscribe if you haven't already.